should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening and welcome to Your Money, Your Call. I'm Chris Kimber. Joining me on the show tonight are Ben Clark from TMS Capital and Roger Montgomery from rogermontgomery.com. If you've got a question about shares, our lines are open right now on 1300 30 34 35. Or if you prefer, you can email us on yourmoney@skynews.com.au. Welcome to the program. Well, another cracker day on the markets today. We're actually up 50 points at one stage, firmly above the 4,300 mark. Market only closed up around about 36, came off a little bit in the afternoon. Most of the action has been in the small and mid caps, where we've seen some very, very big runs across the board, although particularly in some of the resource stocks in the last couple of weeks. Big night tonight in Europe is probably the next thing. So we've got the second tranche of maybe $500 billion, some people think up to $1 trillion, coming from the ECB to the European banks. Not sure if that's good news or bad news, but the market's definitely responding positively at the moment. So, Roger, what have you been up to since we've been on last, mate? Well,
we've all, viewers might not know this, but we've all been talking off air, and you know, we talk between shows as well. And one of the things that I'm noticing is that there's a couple of switches that are going on at the moment. So, so we've noticed that the smaller companies seem to have done better in terms of their reporting than the much bigger companies. There's a lot of growth that surprised me in the mid caps and the small caps, even the nano caps. Yep. I've also noticed that there's a switch going on away from resource companies and into industrial companies. Yep. So small cap industrials, and by industrials, for the benefit of your viewers, I'm talking about companies that aren't resource companies. Right. Yep. So they're not necessarily a manufacturer of something. Yep. But you know, we've seen a lot of great results. So I went away for Christmas thinking I was quite concerned, and I was very, very cautious. Came on the show the last time we were on the program together, and I was much more optimistic. And now the results have come through, and I'm very optimistic about some of these companies.
Okay, excellent.
While I was on my break, I did watch the program a couple of times. Yeah, there was nothing better to do, so and then watch Ben.
Yes, I understand. It's very exciting. You can't miss it. Don't miss it.
And I remember watching a couple of episodes where there were some technical guys, some chartists, and they were talking about the rally being on very low volume. Yeah. Can we just remind viewers that rallies start on, they begin on scepticism and complete disbelief, and very few people participate. Yeah. Everyone's participating you get big volumes in rallies at the end of a bull market, not at the beginning of one. Now, I am still very cautious long term, but based on, we try and focus on the fundamentals of individual companies, and I was delighted that there's not been a lot of volume. I speak to all the brokers. We've got a panel of them that work for us, and they were saying, "Oh, mate, I wish I had a newsletter because I'm not getting any business." And that's exactly what you want to hear. Prices going up on very little volume, because that'll start to attract more volume, and you'll see it continue. Yeah. All right. Excellent. It's a nice bullish start to the show. Market seems to be climbing that wall of worry. We've got David from Melbourne on the line. Hi, David. How can we help you?
Oh, hi. I was just wondering what the panel's opinion was of Luca Resources. Yeah,
listen, thanks very much for your question, David. Look, Luca definitely been one of the better performers over the last couple of years. It's held up very, very strongly. I know it's still on the buy list of at least 2 or 3 of the major brokers in the market, mineral sands. Is that one of yours, Roger, at all?
We were talking about this out in the green room. Yep. In terms of our sort of mid-cap stocks, it was a terrific result. And we actually think that it's trading at a very large discount, almost a 40% discount to our estimate of its intrinsic value. Wow! I've got a list of stocks here, and it's at the top of the list on the mid-cap section of companies that we think are at a discount to their intrinsic value at the moment. Wow! Okay. We should give everyone some context. I think we both agree that there's a very real prospect for iron ore, for example, to lead that trend lower in commodity prices, and that we know there's going to be a supply response in 2013. We could see iron ore prices at at $100 a tonne or $70 a tonne, and then all of the, you'll find that that whole sector will actually follow. It'll be a domino type effect, and I've seen it many times before, and so you do have to be cautious. It does remind me a little bit of BHP last year. People were asking me, well, Roger, BHP is a discount to your estimated value. Why aren't you buying it? Well, that's because we had very, very strong view that those earnings expectations were going to come down, and intrinsic value ultimately would come down as well. But at a 43% discount, you know, there's plenty of room for that value to come down, and it still represents reasonable value.
All right, good stuff. Thanks for that, boys. We've got Ken from Brisbane. Hi, Ken. How can we help you tonight?
Oh, yeah, Chris. I just wondered if you and Roger and Ben could tell us what stocks you've been buying and selling recently.
That is the one question I can't. Ben can answer it, maybe, but I can't.
No, that's all right. No,
I absolutely can't answer that question. Can I just add one thing?
Yeah, of course, yeah.
Because you did promise me that I'd be able to talk about scaffold.
Yes, of course.
Yeah,
Go.
So what was the caller's name? Was it Ken?
Ken, yep.
So Ken, there's 30. I'm just looking at scaffold now. There's 33 companies that are A1 or A2 that have reported, and they're cheaper than their intrinsic value. So if you went in and had a look, you can go onto the website and you can actually you can put in 5 stocks and you can see where they sit. You'll actually see some of the stocks that we've been buying.
All right, good stuff. Thanks for that. Joanne from Melbourne. Hi, Joanne. What's your question for us?
Hi, Chris, Roger and Ben. Thanks for taking my call. I'm wondering about Forge Group. I bought that a while back now at about $2.95 on Roger's recommendation, and I've been buying them in bits as it's been coming down, and I'm just wondering where Roger and Ben think this might go, how high it might go.
Yep.
And I've got some Iris, and I'm just wondering whether I should be selling the Iris and buying some more of the Forge.
Excellent. Thanks very much for your question, Joanne. I don't know whether we can compare Iris and Forge as a switch, but Roger, do you want to start on Forge and we'll come back?
Well, you've obviously done very well.
Yeah.
And
you shouldn't get your relatives to ring, actually, by the way.
No, I should stop getting my auntie to ring, shouldn't I? My family does come from Melbourne, so that's all a very bit uncomfortable, isn't it? Sorry, Auntie Joanne. So you look. I can understand you being a little bit nervous. You've locked in a profit, and you'd like to take some. We think the intrinsic value is still higher for Forge. However, we don't think that intrinsic value is going to grow considerably over the next couple of years. And so while we think intrinsic value is $1 or $2 higher than where it's trading at the moment, because it isn't growing, there is a risk that if we get that sort of, I was talking about the iron ore oversupply or supply response forcing iron ore prices down, you'll get a very quick change in sentiment towards mining services and mining engineering companies, and Forge is one of those. So that is something to be concerned about, or something to watch, but on a purely fundamental basis, good result, and it's cheaper than its intrinsic value still.
Okay, it's time for a quick break, but before that, it's time to start the stock watch. So first we'll start with Roger. What are you watching? And your time starts about now.
In 2005, less than 20% of job ads were online. Fast forward to 2011 and it's more than 50%. And as a result of that growth, SEK's, the ASX code is SEK, SEK's profit or earnings per share has grown from 7 cents to 29 cents. That's 22%. We think there's a lot more growth to come, and despite a decline in unemployment, there's still plenty of options.
Welcome back to the program. On the expert panel tonight are Ben Clark from TMS Capital and the slightly upset Roger Montgomery from rogermontgomery.com. If you'd like a question you'd like us to answer, please call 1300 30 34 35 or email at yourmoney@skynews.com.au. Roger, you do get another 10 seconds.
What the viewers didn't say, that I just kept going. And so look, well, I'll finish up on I think SEK's trading at an 18% discount to its intrinsic value. It's trading at about $6.78 or thereabouts. I think it's worth about $8, and I think that migration online's unstoppable.
Excellent. I think that's a good call. Their result was fantastic the other day. We'll go to Kelly from Sydney. Thanks for waiting on for us. What's your question?
Yeah, hi. I recently purchased Bluescope shares and just wondering what you all thought about Bluescope in the
short to medium term.
Yeah, thanks very much, Kelly. Well, clearly Bluescope should have done exactly what One Steel did and become either no steel or zero steel and change industries, because One Steel's gone nuts. Unless Bluescope can do something like that, I'm going to continue avoiding it as I did with One Steel. So I missed out on the run. What do you think, Roger?
Look, if it can generate the earnings expectations that are out there at the moment in 2013, 2014, that its intrinsic value is about where it's trading at today.
Right, okay.
So a lot of people say, Benjamin Graham had that old phrase, in the short run the market's a popularity contest, a voting machine, but in the long run it's a weighing machine. It's finally trading at its intrinsic value. This company started out 10 years ago. This company had $164 million of equity that had been contributed by shareholders. And in the last 10 years, they've put in another $4 billion.
Yeah, wow.
And the returns are shocking. The returns have just been, it's just been a massive drain on capital. But as BHP has demonstrated, because BHP looked a lot like this years ago, with a change of management, change of direction, change of focus and some patient investors, it can turn around. I'm not expecting that that's going to happen anytime soon though.
And why wait around at the moment? Yeah. All right, thanks for that. I'm going to go to a quick email. This is from Shane and he's from Tasmania. Both Ben and Roger have recommended GR Engineering in recent weeks, only to see it fall 15% last week after its profit announcement. Can they please give me their current thoughts on G&G and how does it compare as an investment to Macca Limited?
Can I go first?
You can go first, absolutely.
The first thing that we need to correct is this idea that Roger's been recommending it in the last few weeks. Absolutely untrue. I haven't mentioned GR Engineering in the last few weeks. And we don't own it in our fund anymore, but we do own Macca.
Yes.
So I think that answers the question. It's worth talking about that a little bit because
absolutely.
When you come onto a program like this as a fund manager,
once a month or something,
and you're only coming on once a month, and people are asking your opinion of a stock, it can change the next day. Some information comes to pass that we see, and we change our opinion. And we don't get the opportunity to come back on the program to say, oh, by the way, yesterday I said I liked something, I've changed my mind now. That's not our... We just don't have the opportunity to do that. So it's very important that investors watching the program use this as a platform to generate ideas, but then they have to do the research or seek advice.
Yeah, exactly. All right, thanks for that, boys. We've got Nick from Adelaide. Hi, Nick. How can we help you tonight?
Good evening, panel. How are you?
Good, thanks.
Just wondering what the Roger and Ben's opinion on CSL, where it's, in the mean term, short to medium term is going to go.
Great. Thanks very much for your question, Nick. Yeah, look, CSL's biggest problem is they've been beaten up by the currency for some time, but they're still managing to edge up there.
We own it in the Montgomery Private Fund. And for us, out of this reporting season, it's one of the few large caps that's at a discount to its intrinsic value as a result of its results. Yeah, so we've got it at a 2 or 3% discount to its intrinsic value.
All right, good stuff. Thanks for that. We've got John from the Gold Coast. Hi, John. What's your question for us tonight?
Yeah, good evening. Just calling about Peak Resources. They've come out with their maiden JORC resource today, which seemed pretty good. Yeah, just want to get an opinion. Yeah,
excellent. Thanks very much for your question, John. Look, I have a feeling this Peak Resources, I think it might be a little mineral sands thing that people have been waiting for them to come out with their resource for quite some time. Not so rare earths.
No, well, it's an A4 anyway, so it's not investment grade for us, but it's rare earths and it's in Tanzania. So there's two interesting concepts to combine. One of the reasons I didn't buy Linus, and even though it looked okay on an intrinsic value basis, was I think that there's a fundamental reason for China to support rare earth prices at the moment to encourage the consolidation of the production in China. But once that's completed, and they are consolidating, they were doing that all through the last quarter and the second half of last calendar year, I think that incentive to keep prices supported will disappear, and it'll be in their interest actually to reduce, to see prices go down. And that could have a major impact on some of the enthusiasm, I guess, that exists for these stocks.
All right, no trouble. Look, the other one I wanted to mention was Fortescue. Had another good run today, and multiple brokers came out and have upgraded, put buys on it with $8 targets. We just had Roger talking about iron ore prices falling off next year. Tech Cominco has bought about 3% of Fortescue and also came out today and said that they're looking for other iron ore projects to buy in Australia because they're obviously finding that easier to do than it is to build a new one. So, interesting conversation.
Well, either way, margins are going to get squeezed, whether it's a
well, see, this is the thing,
a declining price or increasing costs.
BHP, Rio, Fortescue, they're all talking about doubling and tripling. So, are they going to offset the falling price, if iron ore comes off a bit, but they're making 3 times as much of it and selling all of it, is that going to make them still do well? That's
if the Chinese don't need it.
Well, this is the question.
If the Chinese don't need it, and that's why I think it's actually the leading indicator for the iron ore prices activity in China.
So you're saying China demand is going to drop off?
Well, no, I'm not saying. I think that's the leading indicator for any decline in iron ore prices. It's not only the supply response, which I suspect China would want to encourage because it'll mean lower prices for them. So, they're incentivised to see lower prices. But I think the leading indicator of prices is actually activity in China in infrastructure spending. But let me give you an insight. Someone I know very, very well, who's reasonably well connected in the iron ore space, said to me that even if the price drops just a little bit, then what you find happening is that BHP, Rio, Fortescue, they say, well, we've got a contract. It doesn't matter what. Forget about the current price. We've got a contract to supply at this price. And I've heard that the Chinese basically go look under their desk and they say, well, what contract?
Yeah, can't see it.
It's just a rough guide.
Just ask Andrew Forrest about that.
Yeah, it's just a rough guide of what we should pay given the circumstances at the time. But so you just have to be very, very careful. You have to be very careful. But watch activity in China, property, infrastructure spending, that sort of thing.
All right, great. Thanks for that. We'll have to leave it there for a moment while we take a short. Welcome back and thanks for joining us. With me tonight are Ben Clark from TMS Capital and Roger Montgomery from rogermontgomery.com. If you'd like to get in the conversation, please call 1300 30 34 35 or email us at yourmoney@skynews.com.au. Paul from Sydney, thanks for waiting on. What's your question for us? Hi, Paul, are you still there?
Yes, I'm here.
Yeah, hi, how can we help you?
If you could, the panel, please help me with this. This is happening every day on the market with lots of stocks, in particular today, Harvey Norman and JB Hi-Fi and Linus.
Yep.
The stocks are opening on their highs of the day and get absolutely pummeled.
Yep.
In Harvey Norman's case, I watched it drop 23 cents in 15 minutes. I've never seen anything like it. It was just falling at a cent a minute, non-stop. And is this like manipulation to trigger stop losses? What's going on?
Yeah, listen, Paul, thanks very much for your question. Well, hopefully if you just saw that update on Business Night, I'm not going to steal Roger's line, but there was a bit on Harvey Norman there. What happened with Harvey Norman?
You saw Jerry behind the till, so they're cutting costs. Jerry's back at the office every day. And then you saw them showing Jerry an iPad.
It's a salary.
And he was asking, what's that? And it's an iPad. And I think that sums up Harvey Norman at the moment. Sorry about that. But
they fell on a bad result today.
It was a bad result. So Paul, I'm really sorry. There is no conspiracy. This is what happens in markets. In liquid stocks, and you've got a determined seller. They push the price down, and that's all that's happened. This particular business really needs a major structural change to be able to keep up with what's going on online. And they're responding late. They're coming very late to the party. Jerry's been, I guess, slapped on the wrist by Woolworths earlier this week, or might have been Coles this week, when they said, look, the solution isn't to actually lower the limit for GST from $1,000 and raise GST on products bought offshore. Retailers should be lowering their prices. I was at the Reed Gift Fair earlier this week in Sydney, which is the smaller of the two. There's one in Melbourne, there's one in Sydney. There are 2,000 or 3,000 wholesale vendors for furniture and clocks and giftware and jewellery and all that sort of stuff. And I really think that everybody there is behind the times. There needs to be a structural change in the way retailing is done. This idea that you import from China for something for $5, you sell it to a wholesaler in Australia for 10, and the wholesaler sells it to a retailer for 20, and they sell it to you for 85. I just don't think that's sustainable. The transparency that exists now for prices of goods means that prices are going to have to come down. And Harvey Norman is really in a difficult position because they've got a lot of stores. They've always been I've said for a long time, they've always been a property trust.
That's right.
That's what they are, a property trust. But if your property trust is retail stores, arguably that's a very risky sector to be in. Owning commercial property, retail stores, that's a difficult place. I don't know whether this is helpful, but I'm hoping I can share some insights as a fund manager. When we're buying stock, when we're in a position where we're saying, okay, we're going to accumulate this particular stock over a period of time, we will give a broker, you guys, an instruction, and we will say, oh, sorry, Ben, but we'll say to a broker, you know, we want to buy. We want to be 30% of today's volume and no more.
Yes.
Right. So an order goes through and they've got an algorithm and it's super quick, you know, and we'll get roughly 30% of that day's volume.
Volume weighted average price,
well, it depends what the order is, you know. But we don't want to influence the price. We want to know that we're paying the price in the market. We're not the ones determining the price.
Yes.
But if a bad result comes out and we decide we want to get out of a stock, then we don't want to be 30% of the volume.
Yes.
Get us out.
Yeah.
We want to be out by the end of the day.
Yes.
And that will move the price.
Yep.
And that's probably happened in Harvey Norman, which is what
we'll go straight to Stan from Adelaide. Thanks for calling, Stan. What's your question for us?
Good evening, Chris and panel. Questions about Buru Energy. They've had a pretty good run-up lately, and they're up to $1.95 at the moment. Yep. I was just wondering if you guys had any idea as to where this might go, or any thoughts about what this company is going to be doing in the future. Yeah,
listen, thanks very much for your question, Stan. Look, regular viewers will know we were buying Buru last year around about 60, 70 cents. It was one of the shale gas picks we talked about in the Canning Basin. They're, you know, in the same area of New Standard Energy that we've talked about several times. Buru has actually made a very significant discovery. They've put several holes down. What they're basically trying to do is trying to work out how big it is at the moment. Their market cap has gone up to around about 450 million, so it's no longer that small anymore. Two things to consider. Number one, remember, we've got to wait and see how the rest of the drill program goes to determine how big it is. You know, I think they're pretty confident it is a significantly commercial discovery, but there's no infrastructure to the stock. So that either has to be built and usually built by their partner Mitsubishi or a big player. The second thing is Buru Energy's got about $28 million in the bank at the moment. So that is enough for them to keep going for another, you know, probably 6 months. So the only other risk is if they do decide to raise equity, that can always lead the share price to come off a little bit.
I don't follow this particular company. I'll leave that up to you guys.
Yep.
You know, it's a C3 for me, which is down the bottom.
It hasn't made any money yet. It's just found something.
But it's an interesting combination. It's a $500 million company with enough cash to last them 6 months.
Yep.
Remarkable combination of very risky things.
So be careful, as Roger said. It's very, very hard, these things, you know, when they run without earnings to back them up. But, you know, we've seen the boom in the States. 5 years ago, shale gas was 2% of the US. Now it's 25%. They're talking about the US possibly being self-sufficient at some stage on the back of this technology. So it's been more important technology than Apple or anything like that, is what I would say. But look, Roger, I just want to have a talk about those retail stocks. We just talked about Harvey Norman. Billabong, which was one of the worst blow-ups of last year.
Well, that was you in that footage of the guy
on the wave. Yes, you picked it up. Yeah, look, I had to practice that quite a lot. Yeah. So they've had 1 bid, 2 bids. The director said he won't sell for $4. There's rumours of other people coming in. Pac Brands has got a bid.
I don't think it was a director.
Somebody said they wouldn't take $4.
Gordon Merchant.
Gordon Merchant, was it?
No, I don't think he's not a director anymore.
No, he's the largest shareholder.
Largest shareholder. Sorry, yeah. So that's happening. Pac Brands has got, you know, some approaches by private equity. Private equity vultures are circling the sector. What do you think?
Well, look, it's happening, and you know, we've been talking about right at the start of the program. I said there seems to be a shift out of resource companies and towards industrial companies. That includes retailers. The retailers have been on the nose, but that's now old news. You know that if you've been in the market long enough, you know that the market responds to new news. And the old stuff, people dwell on it for far too long, but the market's shifted its focus. So we also talked last year about increasing level of mergers and acquisitions activity. That's happening. And so these guys lead, you know, they lead with their wallets. And they're telling you that there seems to be some value from a trade buyer's perspective. So I look, JB Hi-Fi, I'm not as keen on. Billabong's an interesting one. I did like the Reject Shop's result. I thought that was very good. I probably wouldn't touch David Jones and Myer for obvious reasons. I think there's a structural problem there. And that means, when I say structural problem, I mean it's not a permanent impairment, but it isn't a temporary issue that's going to turn around and be fixed quickly. Well, just on that, Reject Shop's turning around from a really atrocious year last year. And they had a short-term issue, which was the flood damage to their distribution centre. They had a long-term issue in that they'd basically changed their focus. Well, they'd lost their way.
Yeah.
So, you know, years and years ago, in 2004, I bought the shares at $2.40, you know, their average unit price in the store was about $9. And then last year and the year before, I saw creeping into the stores $50 items, $30, $40, $50 items in their stores. That's not what they're about. That's not why people go to the store.
Yep.
So that focus is coming back now. They're recovering from a bad year.
All right, thanks very much for that. Time for a quick break. Welcome back to the program. Answering your questions on shares tonight are Ben Clark from TMS Capital and Roger Montgomery from rogermontgomery.com. If you'd like to get in the conversation, please call 1300 30 34 35 or email at yourmoney@skynews.com.au. We might go to our first caller from Kangaroo Point. How can we help you there? I'm not sure who that is. John from Kangaroo Point. Sorry about that, mate.
You guys know that's okay.
It's Kangaroo from John Point.
Not Kangaroo from John Point. It's John from Kangaroo Point.
The one I rang up on is a little penny dreadful called TSM. But before we go into that, a little while ago you had one of your listeners ring up early on in the year wanting a low cap mining services company. I rang up at the time and I suggested that this might be one that he should have a look at because no one brought it up, but it was AZG. Back then it was about 10 cents.
Yep, AZG, yep.
And I suggested that it might be able to go, you know, to double itself over the next 6 months. And it seems to be doing quite well if you want to have a ticky on it. And that's one I'd like Roger to give me a rundown on because it's only a young company that's only been around for less than 2 years, but it's one that he might be able to give us some of it. TSM he won't like. It's sort of anything, but I'd like to know what's happening there.
Okay, no trouble. Thank you very much. ASG, I think that's ASZ, is it? I think we might have had that one several times before.
ASG Group.
So, sorry, Ben, was that one of yours?
No, it wasn't one of mine.
No, sorry. And TSN, I didn't get the details on that. Obviously, a small mining stock.
Yeah. TSN or TSM?
TSM. No, think smart. Transaction something.
Oh, okay.
Transaction.
Yeah, N for Nelly.
No, well, look, ASG Group's...
Sorry for dropping you in that.
That's
mate.
right.
Yeah.
No, ASG Group's intrinsic value hasn't changed since 2006, 2007. I'm interested in businesses that can increase their intrinsic value substantially, and I'm looking for a demonstrated track record of that, so this one doesn't have it.
Yeah, okay, no trouble. We'll go to Les from Sydney. Hi, Les, what's your question for us?
Yeah, I wanted to ask the boys about Tatts.
Yep.
TS, probably no code anyway, probably.
Yeah.
And I can't understand what's going on. And today they dropped down to hell, and I thought, Christ, what's going on?
Don't panic.
I had them and I bought them for their dividend, and it's going quite good. They've been going up, going up, going up.
Yep.
All of a sudden, crashed today.
Yeah, no, it's a good,
I can't see anything on the announcements or anything.
Yeah, don't worry, Les. It's actually gone ex-dividend. So it hasn't crashed down. Basically, they paid an 11-cent fully franked dividend. So the stock ran up to about 255.56 yesterday afternoon. So the stock went up from 243 to 256, filled up with a dividend, went ex 11 cents plus your franking credits. So to the certain types of investors, it's probably worth 15 or 16 cents. And it's just
more than that, hasn't it?
And it's gone down a bit more than that.
Yeah.
So look, you know, what do you think about Tatts in general?
Okay. We don't own it, and we won't own it for the foreseeable future. And the reason for that is that one, it's trading above its intrinsic value. And two, that intrinsic value is forecast to decline, such that its intrinsic value has been steadily dropping since 2006, 2007. And we just don't own businesses like that. There's not much point me talking about any more than that. Everything I know about the company is summarised in that statement.
Yeah, all right, no trouble. Andrew from Hobart, how can we help you tonight?
Chris, Ben and Roger, I'm interested. You just mentioned Webjet. I'm interested in the Roger and Ben's outlook for Webjet, please.
Yeah, no worries at all. Thanks very much for your question, Andrew. Look, Webjet's actually had a very good result the other day. Run up on the back of it. You know, but we were just talking about things like this. What do you think, Roger?
It was one of the top results of the reporting season. You know, that and there was Macmillan Shakespeare and SEKO, and there's a few of them. But this is a very good result. Sadly for me, it's not good value. You know, I can't buy it. It's not cheap enough. So, you know, I like buying really good quality businesses. This is one of them, but it is trading at a substantial premium to my estimate of its intrinsic value, which is $2.07. So it's trading a full $1 above what I think it's actually worth.
All right, no trouble. Look, just another stock I've got to bring up is because it is QBE, and we know that you know, we had several other panellists, neither of you two, that had buys on QBE. You know, the stock was one of the worst performers last year, got 45% drop in profit, and then of course has just raised $500 million at $10.75. I think the placement went off at, although you don't get the 25-cent dividend, Roger.
Well, I've just written a 1,500-word column about QBE, which I'll put up on my blog probably next week. I think there's a couple of things. One, Frank O'Halloran leaving, I think that's a negative. I think he was, you know, he demonstrated up until about...
loved.
Yeah, well, up until 2007, the company's intrinsic value just kept going up every year. They make very soundly priced acquisitions, and in fact, the big acquisitions that they made last year added about 35, I think increased 35% their premium, gross written premium, which is great. The difficulty, the result that they've just reported, which is their 2011 full year results, their combined ratio went up from 89% or thereabouts to about 96%. So that their profit margin just got squeezed. I think what Ben was saying is right. They need to have a year where there's less catastrophes because their reinsurance costs are going up.
All right, so 1,500 words from you coming out next week.
Correct.
All right, great. Thanks for that.
Can't get that in 30 seconds.
No, that's very true. It's a bit difficult. Look, that's all we've got time for today. So thank you so much to our guests from Ben Clark from TMS Capital and Roger Montgomery from rogermontgomery.com.